last couple of weeks, we've seen an absolute roller coaster ride on the global markets. And the big question is, how is this impacting boomer savings and retirement bonds and shares and superannuation, etc.? So today we've got Nick Bruining. He's our Starts at 60 finance expert, and he's here to answer all of those questions for us. So Nick, over to you. How has all of these historic drops and everything that we've been hearing over the last couple of weeks, how is that going to affect Aussie over 60s with retirement income?
Well, Wendy, thanks for having me. It has been a scary couple of weeks. There's no doubt about it. And we saw, at one stage, the Dow Jones, which is a measure of the US market, dropped by 1,000 points, which is a record number. But interesting enough, because the Dow's now so high, as a percentage, it wasn't that great. I mean, not insignificant, but in the big scheme of things, it wasn't as big as we sometimes have seen as a percentage. Look, the point in this is that this is the stuff that always happens with share markets. It's the price we pay to get those double-digit returns we've been enjoying for the past few years or so. But look, it's a lesson that's really good because we've seen a bit of a recovery since the tumultuous couple of weeks ago. And in fact, the Aussie share market's recovered about a third of what it lost in that period of time. So we sort of recovered, but there's a lesson to be learned from all of this. So let's just talk a little bit about what caused all of this turmoil to occur. It actually goes back, would you believe, to COVID. And what happened was that when we saw the world's markets collapse effectively, governments instantly reduced interest rates, if you like, to encourage people to spend and continue to buy things and do things. Now, as a result of that, when things started to come good again, we saw a big upsurge in inflation because things weren't there. The factories were closed, and whatever you would buy, you had to pay a lot for it. So we saw a big lift in inflation. Now, the only way that central banks can control inflation really is to raise interest rates. And the theory is that if you're spending more money on paying your car loan or your mortgage, there's less money you're going to spend down at the coffee shop or buying a new car or a new phone. So they use interest rates to control the tempo of the economy, if you like. And I guess that as we've come out of this sort of COVID-inspired downturn and the things have really picked up, the markets have been looking for central banks to start lowering interest rates, saying that, well, you know what? We're out of the COVID recession. Everything's good. Things are back to normal. Hopefully, we'll see a period where we start to lower those interest rates. And it's kind of weird, but we had this period for a while when a little bit of bad news meant, oh, that's good. They'll lower the interest rates to encourage the economy again. And then it all kind of went to pot a couple of weeks ago. So a couple of things happened. Firstly, we saw big organizations, big businesses like Tesla, electric cars, and Google, Alphabet's the parent company, report sales that were less than were expected. And everyone thought, oh, that's not good. That's not good. The other thing that happened, and this dates all the way back to, believe it or not, the 1987 share market crash, right? The Japanese, ever since then, have had interest rates at almost zero. So while we enjoyed a couple of years of interest rates through the COVID coronavirus at near zero, the Japanese have had it since 1987. And a couple of weeks ago, there were whispers around that the Japanese were going to start lifting interest rates. Now, what the whole world's been doing for the last 4 decades is buying money or borrowing money from the Japanese for next to nothing and investing it. And of course, if suddenly they're going to start raising interest rates, all those deals fall apart. And that's what happened. The Japanese share market dropped 12% in one day simply because they thought those interest rates were going to happen. Now, this all happened on the day that the US economy showed that unemployment went from 4.1% to 4.3%. So you had all of these things piling into the market, and the people in the market, no, we don't want any part of this. We're going to go to safety. We'll get out of the market. And they sold, and that's why the share market went thump on one particular day. But here's the thing. No one saw it coming. No one ever does, and it's going to happen again. Right? So the trick for our Starts at 60 fans is to sort of, what lessons can we learn from that? Well, the lessons to be learned from all this sort of stuff is these things happen again. But the trick here, which is what financial planners do, is to protect your money, to protect your super from these sorts of events happening.
How do they protect the super?
Well, it's a great question. And for most of us, we like the easy world. We give it to the super fund, we stick it in an investment option, say capital, stable, or bounce with. The super fund's going to look after it. But here's the thing. You need to keep an eye on these things, because if you do, you can make how much the money you've got in superannuation and your investments generally last a lot longer than they might have otherwise. Now, to to understand why, understand how sort of financial advisors look at an investment portfolio. If Wendy came to me and said, look, Nick, I've just been given $30,000 by my mum and dad, lovely, and I'm going to buy a new car. What should I do with that $30,000? Because I don't want to buy it until the end of the year when they're on special. That's fine. So you might think to yourself, well, the share market's fallen a bit. Now's the time to put it in shares because I could do pretty well out of that. A good financial planner is going to say, no way. Why? Because we have no idea what the share market's going to do over the next 3, 6, 5, 12 months, whatever. So we call that money short-term needs or short-term expenses. That money we always keep in cash, C-A-S-H. Sure, you get the best rate you can. You know, it starts at 6, got terrific resources to find out who's offering the best rates out there. But that's where you keep it in cash because you know you're going to need that money in 6 months' time, 12 months' time, whenever you buy your car. But the car you're going to buy in 5 years' time, I have no problem investing it in areas which will grow in value. The probability of you coming out backwards is a lot less over a 5-year period than it is over a 6-month period. Now, all we need to do, Wendy, is to take that concept and put it into what we do with our superannuation funds. So remember, short-term, up to about a 2-year period. That's the expenses you're going to be drawing your money out from on a regular basis. It might be the super fund that's paying you a couple of $1,000s a month. That's what we want to keep in cash. Now, it's really interesting to understand how a super fund actually works. So let's just say, as I say, you've given your money across to a superannuation fund and you put all your money into something safe that sounds pretty safe called capital stable, right? And you can see on the screen here, this is what a capital stable fund kind of looks like. This is a mix of investments. So it's going to have around about 60% of the money in this stuff it's called defensive, and about 40% of the money of the stuff it's going to call growth. Now, we can substitute those words for growth equals risky, right? And defensive equals safe, and that's what it is. So you're going to find that your growth assets or your growth area is going to be investing in things like shares and property and all that sort of stuff. So this chart shows a typical sort of mix-up of a capital stable fund. And you can see that we've got around about 10% in international shares, around about 30% in Australian shares, and on the safe side, on the defensive side, about 50% of what we call this stuff called bonds, which are almost like a big term deposit offered by governments and corporations, and about 10% in cash. Now, here's the thing. When you've invested your money in your super fund, you bought these things called units, and the units simply represent those underlying investments that we can see on the screen there, right? But every day, those investments supporting that units are valued, right? That unit price is valued. So if you get something like the share market goes up, then your unit price goes up. But if the share market falls, then that part of your capital stable fund has dropped in value. And that means that if your payment is due on a day when the share market's fallen, the fund manager, the super fund, has to sell more shares to make up your money. It makes sense. You know, they've got to pay you $2,000. How do they do it? They sell the shares, they sell the bonds, they've got this, they've got that. And that's the problem, because if on the day of your payment the market has crashed, like it did a couple of weeks ago, they have to sell a whole lot more units. You've got less units to recover when the market eventually comes back up again, which it always does. So here's the trick. Here's the little secret. It starts at 60 fans. You actually run two sorts of super funds. And on this screen, you can see that I've got a small amount parked in cash. And we generally have something like 10% of the money in your super fund parked in the cash unit. Why? Because that's where we take the payments from. That's where we take the money for the new car from. That's where we take the money for the trip from. And what we do is we keep an eye on the capital stable or the rest of the super fund. And every 6 months ago or so, you have a look at the value of your super fund. And if the growth part's gone up a bit and you've made a profit, you just simply take that profit and you top up the cash pool. Okay? So basically you've gathered the profit. It's like having, gathering the harvest. You've made the money. Let's cash in the money. Take the money and put it into cash, top up the pool. That's the money for the next year or the next couple of years or whatever. And of course, if you have to check your fund and it's gone down in value, what do? Nothing, Lindy. You just leave it sit there because you know inevitably it's going to come back up. And when it does come back up and you have another look at it in 6 months' time or so, and then you've made the profit, then you take the profit and put it into cash. So if it's gone down in value, you leave it sit. If it's gone up in value, you take the profits. And I can tell you that when we do that for clients, usually you see that the money lasts sometimes years longer than it might have otherwise if you just cash out units. And the more risky your super fund is set up, the more important it is to do this sort of stuff. So I'm talking about capital stable, which is a reasonably safe kind of investment mix. But if you've got your money in balanced or growth or something like that, it's even more important to look at those profits and take them when they're there, because you never know what's around the corner. Because as you move up from capital stable to balanced and high growth, all that means is you've got more of those risky assets in there. There's more shares and there's more things to go down if there's a market crash. So that's the key. Take the profits when they're there, leave it alone when it isn't.
That sounds like common sense.
Common sense is what always wins the way, Wendy.
Yeah, but you do make it sound very simple. But obviously, I think one of the things is getting financial advice for people who, perhaps it's not as simple for them, I guess. It's just one thing to keep in mind and I think whenever we have these conversations, Nick, you do make it sound very, very easy. And I think we should probably also preface that it is just general advice and people should always go and get, specific advice to their specific circumstances.
It's a great point, Wendy. And look, here's the thing. I mean, there's some fantastic super funds out there. It's not a super fund in Australia that I'm going to bag because they all do a fantastic job, right? But they don't do this kind of stuff, right? They don't move your money around to cash to top up the payments for your holidays and expenses and all those sorts of things. It's something that you have to do. Whether you've got a little super fund or a big super fund, you do have to take control of these things and manage the asset allocation. You can, of course, get financial advice, and there's plenty of great financial advisors out there. One of the organisations, there's a couple of places I'd have a look. Starts at 60 is a great resource to kick off with. But there's also the Money Smart website, moneysmart.gov.au. Tells you how to get good financial advice. And there's two associations to have a look at. The Certified Independent Financial Advisors Association, that's CIFAA.asn.au. They're the independent financial advisors, which I'm one of. And then the other organisation is the Financial Advisors Association of Australia, FAAA.au, and that's the other financial advisor who are generally tied to a super fund or something like that. So there's plenty of resources out there, but probably the best one, of course, is starts at 60.
Fantastic. Well, thank you, Nick. Appreciate your time today, as always.
Thanks, Wendy.